We are on a mission to help 1 lakh investors reach a 1 crore portfolio. You can start from wherever you are, even with a small amount. All we ask is that you think big and stay committed. If you're someone who wants to build wealth the right way, backed by research, discipline, and the right support system, we would love to work with you. Or if you know someone who needs this, share this with them. Let's start the conversation. Fill out the form in the description below, and our team will get in touch with you.
In this video, we will look at the various types of equity mutual funds. Under equity schemes, an equity mutual fund is a type of mutual fund that invests in equity stocks and related instruments to generate long-term capital appreciation. We'll discuss the various types now. Multi-cap fund. An equity fund should invest the minimum of 65% of its total assets in equity instruments, which include large cap, mid cap, and small cap stocks. The fund manager diversifies the portfolio across various capital funds. In a large cap fund, the fund manager invests a minimum of 80% in large cap equity companies, focusing on the top 100 companies of the Nifty 500. This approach offers several benefits, including investment stability, as these companies tend to be less volatile and more stable. Such investments are also advantageous during unstable market conditions, given their high demand and liquidity. Next, mid-cap fund. In this, the fund manager invests a minimum of 65% of the funds in medium cap equity companies, especially those ranked between 101 to 250 of the Nifty 500. This investment strategy allows the investors to benefit from diversification and potentially higher returns compared to large cap funds. Next, we move to small cap funds. The fund manager invests a minimum of 65% of the fund in small cap equity companies, specifically those ranked between 251 and 500. This strategy provides investors with several benefits, including exposure to emerging companies and the potential for higher returns due to growth opportunities. However, it is important to note that small cap funds tend to be riskier and more volatile compared to other types of funds. The next category will be large and mid cap funds. The fund manager is required to invest a minimum of 35% of total assets in large cap equity and at least 35% in mid cap equity. This strategy allows investors to have a more diversified portfolio, which typically carries less risk than mid-cap investments while offering greater returns than large-cap funds. Dividend yield. In this fund, the fund manager invests in stocks that yield higher dividends, maintaining a minimum of 65% in equity funds. When investors choose these stocks, it can provide passive income. An example of a dividend yield fund would be Aditya Birla Dividend Yield. The next category would be value or contra fund. Contra funds are a type of equity mutual fund that follows a contrarian investing approach. This strategy focuses on investing in stocks that are currently underperforming or out of favor in the market, yet have strong fundamentals and potential for future growth. The goal is to purchase these undervalued stocks at low prices and hold on to them until their value is recognized when market conditions shift in their favor. The next would be focused funds. A focused fund is a mutual fund that holds a relatively small number of stocks or bonds that are similar in some way. By definition, a focused mutual fund concentrates on a limited number of stocks, typically a maximum of 30 across a few sectors, rather than maintaining a broad and diversified portfolio. The next category would be sectoral or thematic funds. These funds concentrate on investing in specific sectors of the economy such as banking, technology, healthcare, or energy. The goal is to take advantage of the growth potential within a particular sector. For example, if the IT sector is thriving, a sector-focused IT fund would aim to capitalize on that growth. However, this type of fund carries a higher risk due to its lack of diversification. Next would be ELSS, that is Equity Linked Savings Scheme. A fund manager invests a minimum of 80% in equity within the ELSS funds. Investors in ELSS are eligible for a tax deduction of up to 1.5 lakh per year. It's important to note that ELSS has a lock-in period of 3 years, meaning you cannot redeem your investment before 3 years from the date of investment. These are the various types of equity mutual funds. In the next video, we will look at the various types of debt mutual funds.